Hedge funds. Hedge funds have been the most popular investment fad over the last 15 or so years. Hedge funds have been thought to be the source of riches and wealth, and a lot of ordinary investors dream to invest in hedge funds. First, hedge funds are only for qualified investors. And qualified investors, number one, means wealthy, as in rich, and number two means institutional. These are the same investors, and distribution of hedge funds is the same as private placements. You can't buy a hedge fund on the market. You gotta get a private placement. In order to get a private placement and to satisfy the law, you have to be wealthy and rich. So it's only for the rich, only for the well-connected people. Okay, you gotta have connections. You gotta know people. Number three, no regulations, as in no regulatory oversight. Basically, this is the same as there's no regulation. They can do anything they want to do. They can invest in anything. They can go long, they can go short. They can increase risk by increasing leverage, okay? They can do all of those things. These qualified investors, I am reminded by the textbook, they use another word which is exactly the same, means exactly the same. They call the accredited investors. Accredited investors is the same as qualified investors. Number four, these usually, almost always, but not always, almost, most of the times involve significant risk. Early on, when there were few hedge funds, those few hedge funds, the hedge fund manager says, we are better than the others. We can make extra return for relatively low risk. Well, there's a genuine relationship in finance. It's one of the two primary laws in finance. The first law in finance is that time has value, the time value of money. The second law in finance is that there is a relationship between risk and return. And the only way to get a higher return is by getting higher risk. There's no other way in finance. So early on, the early hedge fund manager says, well, the markets are not very efficient, and we're able to get extra returns at relatively low risk. Well, as the market got more and more competitive and more hedge funds began to move in, there was one and only one way to get those extra returns, and that was through taking excessive or extra or significant risks. So risk became a major strategy of hedge funds. They play for risk and they hope they are lucky. Okay? And when I have, let's say, 500 hedge funds, 200 will be lucky and will make phenomenal profits, and 200 or 300 will not be so lucky in the process. The next key characteristic is privacy. As in, there is private placement. When you invest in the fund does not have to disclose that you're an investor and how much money you have in the fund. Maybe you have 10,000, maybe you have 10 million, maybe you have $100 million. So they don't have to disclose to anyone how much money you have. So your investment is secret over there. And rich people like secrecy. So privacy is the same as secrecy. Now, it does not mean that these people cheat from taxes. It doesn't mean that they don't pay taxes. All it means is that if you're a journalist or a curious guy or just somebody, it will be very difficult to find how much this guy has in this hedge fund or in that hedge fund. So again, that's important for rich people. Now, definition of accredited or qualified investor. Definition is, this is just law. Wealth, 1 million. If you got a wealth of more than 1 million, wealth is called net worth. Your assets are worth after all credits 1 million. Or you have an annual income of 200,000 annually. This was designed to include very good lawyers who can make $500,000 a year and some of the highly paid doctors. A doctor can make 250,000 or can make $500,000. Some top doctors can easily make $1 million. So that's the definition. The next key characteristic is a lock-in period. A hedge fund will reserve the rights, and the investor will have no right to withdraw their money when they want. They lock you in, and I'm picking a number, which may be true. 12 months, 2-year lock-in period. You put in your money within the hedge fund, you have no right to withdraw your money before 2 years. The hedge fund, now you may request your money, and the hedge fund may decide to give you back your money, or it may decide not to give you back, or it may decide to give you only partial withdrawal, okay? So they can do that if they like. Almost all hedge funds will have a lock-in period. So you put your money in, it's frozen for 2 years. The hedge fund may be losing and losing and losing money, but you can't get it out early. This is to prevent forced liquidation, because hedge funds use, let's put it in here, significant risk, I will add, but it is related. Either way, high leverage. Yes, there's water or noise. Yeah, these things happen in the real world. Leverage. Most of these funds will have very high leverage. They'll borrow, and by raising the leverage, they'll raise significantly the risks. And if they return, the return will be very high. So a 5% return with a significant leverage could be magnified to 20%. Well, if the fund starts going down, you can't withdraw your money because it will force the manager to sell at a loss. So the significant risk, usually caused by the high leverage, forces managers to lock in the money. And they legally, in the contract, lock in the money. If you don't want your money locked, don't invest in the hedge fund. Okay? And in the hedge fund, you can lose all of your investment. It's perfectly possible. Again, you can make a lot of money, but you can also lose a lot of money. And in hedge funds, you can lose even more than in a mutual fund because there is a significantly higher risk, usually driven by or coupled with significant leverage. All right, a lot of times, again, this significant risk is caused by what we call aggressive strategies. Aggressive is a very difficult word, but aggressive basically in finance on Wall Street is another word for risky, as in very risky, as in speculatively risky. So aggressive strategies basically means that these guys speculate. They speculate on whatever. They speculate any way they can make money. And now speculation will involve very high risk with a short-term expectation that within 3 to 6 months, let's say the Japanese yen will crash, or the Chinese stock market will crash, or whatever. Let's say oil is going to shoot up, or gold is going to shoot up. So, or some company will be taken over. So when there's an acquisition or a merger, the company value is going to go up. Somehow they speculate, okay? Let's see what else. Some of these strategies, aggressive strategies, will include short selling. I already wrote, will be, it's exactly the same, I'm just copying. Leveraging. The next strategy will be program trading, and I already covered that a long time ago. And very, very, very big and very prominent will be derivative trading. In other words, mutual funds are prohibited from, a little better, are prohibited from investing in derivatives because derivatives are considered too risky for mutual funds. Well, they're fair game for hedge funds. Hedge funds love them, okay? And hedge funds do believe that they may be mispricing in derivatives. They use derivatives, like all derivatives, as we already studied, for pure speculation, and they use, of course, derivative occasionally for hedging. You know, hedge funds sometimes, rarely hedge. They became popular in the 1990s. And now are probably the most popular financial institution. The most popular way, the fad today, will be either investing in a hedge fund, if you can, or investing in an ETF. And everybody can easily invest in the ETF. Okay. Number 9. I missed 2 important pieces here. Number 9. They are, hedge funds a lot of times, highly specialized. They will focus on technology or biotech or whatever particular financial instruments, mispriced options, whatever. They'll be focused. So highly specialized and oftentimes focused, but not necessarily. Okay, that's another number 9. And supposedly, which is mostly true, they have a very specific, that's part of number here, is specific expertise. Specific expertise. So, these are the 10 main characteristics of a hedge fund. And now I have a whole bunch of, this is long, difficult, a little tricky to chart, is types. Now this is very long, but you need to. So here's a very nice way that Wall Street describes them. They call them number 1, or sorry, A, more risky. More risky is kind of like, remember, they always tell you things without really describing. More risky means very, 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 very risky. Highly risky, and a lot of times highly speculative, a lot of time. These are, they call them most, and again, that's how they describe them, aggressive. Which means they're going to take a lot of risks, hoping for a lot of profits. Number 1. That's actually the name. That's how they call it. Aggressive growth. Funds means hedge funds. Aggressive growth means you expect somewhere, somehow to be major growth. Maybe there's a little particular industry, like pharmaceutical industry, like biotech industry, that may provide that magic pill to regrow hair. Man, if they do that, they'll be billionaires. And if you invested in them, you're going to be a millionaire. Or there could be phenomenal growth. For example, there was, for almost 10 years, phenomenal growth in Brazil. We already covered I'm just giving it as an example, the BRICS. Brazil, Russian companies had phenomenal growth. Indian companies had phenomenal growth. Chinese, South Africa, okay? So, later on, the newer frontiers were Thailand again, I repeat, Vietnam, Cambodia, Indonesia, some Malaysian companies. So sometimes these will be developing or underdeveloped with a phenomenal potential for growth. Usually has expectation of high growth and little to no dividends. In other words, these are companies that don't pay out dividends, and instead they reinvest the money for the business to grow. Now that's number 1. Okay, sometimes that will be one type. Sometimes, I already explained, I'll write it out. It could be specific. It's called emerging market funds. Emerging has exactly the meaning. An emerging economy, emerging market means undeveloped or underdeveloped. Again, the best examples were or are Indonesia, Malaysia, Thailand, Cambodia, Vietnam. So, sometimes these growth funds will be investing in anything growth. A lot of times you'll have specific emerging market funds. They will not invest in developed countries. They won't invest in US or UK or Australia, okay? They'll invest only in countries like South Africa, where expectations are relatively high. Back in the older days and even today, Turkey may be considered an emerging or developing economy, okay? You gotta understand, out of 120, well now there are over 200 countries, but out of 120 countries, 20 countries are developed and 100 countries are developing, same as emerging. So this provides a much bigger potential for growth, but of course emerging markets are very risky. You invest in Russia and the Russian government can confiscate your property. Or you have mafia problems, or you have legal court problems. So these investments, emerging markets, are always a lot riskier, but they can provide phenomenal profits if you invest in the right market. So what these guys are saying is, hey, we can pick the better markets and the lower risks. They could be number 3, macro funds. And a macro fund will be investing in macro fundamentals. They look at the country, they see Singapore is going to go up and up. They invest in Singapore because they expect Singapore to grow better. Or they expect in a small country that is very well developed, I lived for 3.5 years, Macau. Maybe gambling. Gambling is very popular in Macau. So they say, well, we see gamblers coming from all over Asia, gambling in Macau, we see gambling growth, so Macau economy is going to grow. Well, if the gambling casino grows, the retail business like Louis Vuitton and Gucci and Prada, all of these businesses will be making great profits. And some other country, they see, hey, maybe there's a revolution coming. In Thailand, you have the yellow shirts and the brown shirts. There's like civil unrest. And they say, well, we think Thailand isn't going to do well, so we're going to short Thailand and go long Cambodia. Because they believe that the Cambodian economy is going to outperform the Thai economy. Remember, it doesn't matter which one is higher or lower. The only thing that matters is which is going to grow faster or slower. So macro funds try to find countries which will perform better than the rest, or countries that will perform significantly worse than the rest. For example, a lot of people made bets expecting oil prices to go down, 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 and down, and this hurts the Saudi economies and Saudi companies and Saudi government. So you can bet in a macro fund that Saudi stock market is going to go down. If you made the bet, you would make a lot of money. Okay? So this is an example of a macro fund. There are what's called market timing. Somehow they'll try to time the market. The market timing fund will focus on asset classes. And I already discussed, and I'll repeat again, the 5 primary asset classes will be stocks, bonds, currencies, real estate, and commodities. And if they think commodities will go up, they will invest either broadly in commodities or in particular commodities like uranium and silver. Right now, as we speak, one of the most undervalued commodities is platinum. Platinum has always been the price about twice of gold. Right now, platinum is cheaper than gold. So what they can do is they invest in platinum, believing that platinum in general commodities are relatively cheap, okay? They may believe that bonds are overvalued, so they may decide to short bonds. They may think that, oh, the stock market is too overvalued, like those in China, in Japan, and maybe most in Europe, and they will probably do that. So they will select particular asset classes. An example of a market timing is, for example, we are now June 2nd. Just in a couple of weeks, if you read the news, you'll know that in Britain, the British will vote whether to leave the euro or not. This particular event, it's not part of anything here, is called Brexit. It is Britain exiting and leaving the European zone. Some people believe that if Britain actually leaves the European zone, that will be very bad for the British currency. It's going to be very bad for the British stock market. So these guys will just short the whole stock market in Britain, and they'll short the whole currency at the same time. You short them both. Currency falls, you make money. Stock market falls, you make money. If they exit, the expectation is both of them will fall. You're going to make double on your money. And you're going to leverage on top of that. Okay? So that's what these market funds do. And sometimes you have another separate category called short selling funds. They will usually, but not always, usually focus on overvalued stocks, and if something's very overvalued, they'll short it. Or overvalued bonds, possibly, and they will short them. But they can focus also on overvalued currencies and short them. So these specialize mostly in shorting. They profit when the market goes down. So a lot of times if you want to diversify, you want to have long-only funds like mutual funds and whatever. You may add a short-selling fund that will very likely, almost certainly profit when the market goes down. So short-selling funds are good to add as part of your overall portfolio and as a diversification. If it's very well run, when the market goes down, they will surely make profits for you. So they're good to use as an extra diversifier. Number B, moderate risk. Okay, so what's moderate risk funds? They are relatively more traditional, they're relatively more common. Let's try. 6. Distressed funds or distressed securities. Financial distress is kind of like the same as financial trouble, experiencing difficulties in servicing your debt. You may be already in default, or you're so short on cash you're likely to default. Example of distress was the state of Puerto Rico or Puerto Rico. And Puerto Rico was in trouble. They didn't have the money, they couldn't pay back their loans, they were in financial distress. Payments coming in constantly, meaning they have to make the payments, but taxes aren't covering those payments, and they still have plenty of expenses. So Puerto Rico debt was in distress. It was selling as junk. If they're able to pay well, very likely you're going to make a lot of money. Or if the US government gives them a bailout, you're going to likely give them money. Or distressed means that they already defaulted, let's say some company already defaulted, and the debt from 90 cents on the dollar meaning a 10% discount, is selling at 5 cents on the dollar, meaning you get it at 95% discount. And if you get it at 95% discount, there's a good chance that if they pay, let's say, instead of 5 cents, if they pay 10 cents, you're going to make a profit. Distress means that they are already in bankruptcy. So they're going to sell for 2, 3, 5 cents. They're in liquidation. They're in organization. Somehow they're in a big trouble. And if they're in a big trouble, the security isn't going to be selling for 90 cents or 80 cents. It's not going to sell at 90 or 80% of its value. It's going to be selling at 20 or 15 or 10. Maybe you're going to be able to buy it at 5%. Then you go through courts, through lawyers and everything else, and if you bought it at 5 and you recover 15, you make a 200% return on your distressed investment after lawyers and courts, okay? And you have to wait a year, 2 or 3, until it gets resolved, okay? So these are distressed securities. They're usually companies, but it could be governments. Governments are getting in trouble too. Sometimes these are called and they're known as deep discount securities. I've just already explained. Discount will be 10-20% off the full price. Deep discount will be 80-90%. 95% off the full price. You will have another one called fund of funds. This will be a hedge fund manager who is very well connected with other hedge fund managers. He will know what other hedge funds are investing. He will know which hedge fund managers are good managers and honest and hardworking, and which one are fraud. So this particular guy will specialize in investing in hedge funds. Because there are 600 hedge funds, well, now there could be a few thousand hedge funds, he will know this guy, and this guy are the best in the field. So out of 600 funds, he will invest only in 10 funds. He will select the best of the best, okay? And he will also hope for some sort of diversification. If one fund is doing well, another one may be doing poorly, or if this fund growth is not doing well, maybe distressed will do better, or something else will do better. So fund of funds is basically all you're doing is you get the money and you invest in different funds. 10% in this fund, 10% in that fund, 10%. So you get a lot of extras, diversification. Each of these is already diversified, but now invest in a whole bunch of different funds, some in developed countries, some in developing countries, okay? You're going to get, hopefully, an extra diversification. The main disadvantage on a fund of funds is that you get double fees. The funds already pay big fees, hedge fund fees. And then your fund will pay fees on top of these. So you're paying fees twice, for the benefit of expertise and for the benefit of diversification. Some people believe it is worth it, other people believe it is not worth it, okay? You have to make a judgment. But there is a genuine benefit in knowing somebody who has the expertise to select the better funds for you. Instead of you trying to select them on your own, someone else has the expertise, can do that for you, but you have to pay fees for his expertise. So there's a trade-off there. All right, next, number 8. Opportunistic funds. These profit from particular events. Again, the event may be expected bankruptcy of a company, expected bankruptcy of a country. For example, expected that the country will enter the European Union. That's how it was for my country, Bulgaria. We joined the European Union in 2008. And in 2004, 5, and 6, a lot of people invested in Bulgaria in the expectation of entering the European Union. Right now, the big event is, as I wrote it up there, Brexit. Okay, so you expect certain event to occur. Sometimes the event will be special IPO. Sometimes the event will be a merger. The event will be an acquisition. Okay, the event may be, let's say, before, I'm talking about 1999, Hong Kong being an independent country, becoming part of China, all right? All of these are events that you expect, but you still don't know if the event will occur for sure, what the event would be. Well, guess what? This presented one of the greatest investment opportunity of a lifetime. China was back then totalitarian, run by communists. The most capitalist free economy in the world back then was Hong Kong itself. So Hong Kong and China represented the two ultimate extremes of a command economy and a free economy. Everybody believed that when China takes over Hong Kong, they'll ruin and wreck and take over, completely destroy the Hong Kong economy. So phenomenally expensive apartments would sell suddenly dirt cheap. Prices in Hong Kong in certain areas could fall 10 times. You better get rid of it for anything. Sell it for 10,000, sell it for 20,000, sell it for anything. When the Chinese come, they're gonna take it anyway, okay? So you're gonna lose it all. Better sell it for something. So that was a phenomenal event that allowed some people who are willing to take the risk and buy dirt cheap property in real estate. Let's say buy a property for $40,000 to be worth today $1 million or $2 million, making 20, 30, 40, 50 times your money if you decide to take a risk, okay? So you usually go also in countries where there is a revolution. People shoot at each other. People kill each other, okay? When there's a dictatorship which is falling apart, or a new dictator comes, or whatever the social, political, economic event might be. So that's on the country level or on a corporate level. Well, that represents an opportunity to take a risk and profit if the risk works out. A few more minutes. Multi-strategy funds. These claim to be very well diversified, to use a number of different strategies which allow them to be relatively more diversified. And there is almost the same as opportunistic. They're called, next one is special situation funds. In these special situations, again, could be mergers, hostile takeovers, reorganizations, leverage buyouts. Again, mergers, takeovers, reorganizations, leverage buyouts. These are specific events, so they are very similar in nature to opportunistic funds, specific corporate events. But the opportunistic will also be not just corporate events, could be global economic. Opportunistic fund, there's a war. There's a war, stock market crashes 95 or 99%. Let's say just up until recently, one of the best investments in the world was Iraq. Iraq's been a war for over 10 years. Stock market crashed 50 times. Well, now they're dirt cheap. Another great opportunity is the whole market of Cyprus collapsed. Cyprus banks collapsed, they shut down, the whole market. Well, there are a lot of dirt cheap stocks in Cyprus. All right, and 3, 4 more. Let me see where I'm going to go. Okay, I can go over here. So this is A, B. Now we go to C. Just a few more minutes. Risk avoidance. Risk avoidance is like low risk funds. Number 11. Income funds. They invest in bonds that will give you high interest. And they'll invest in stocks. Is it Facebook time? Right? Facebook time. And they'll invest in stocks that give very high. So they focus on providing you income. If you're old retiree, you may want to invest in one of those and give you. Next one, number 12 will be market neutral. Market neutral arbitrage. Let's see what's happening here. Usually, in an arbitrage, you will invest in 2 different securities of the same issuer. You will maybe investing in the bond and shorting the stock. The bond may have, or you may be investing in a warrant and shorting the stock. So it will involve, arbitrage will involve 2 securities of the same issuer. One of the security usually overvalued and the other security usually undervalued. In other words, you will exploit mispricing within the same issuer. Usually a stock, or a bond, or a warrant, or a convertible, whatever the hybrid security will be. Market neutral. Market neutral strategies is the first original genuine hedge fund strategy. You invest in some stocks long, you invest in other stocks short. The weight of the long to short balance is close to 50-50. If the market goes up, you're going to make up on your longs and you're going to lose on your shorts. You're not going to be losing money. If the market crashes down, your shorts will make for you significant profits. When the market goes up, you expect your stocks on the way up to go more than the shorts, so you make money on the way up. When the market goes down, you expect your shorts to crash more than the other stocks. So you expect your longs to outperform the shorts both on the way up and on the way down. Market neutral means that whether the market goes up or down, you're not exposed to market risk because your longs and shorts cancel each other. All that you did was select the better longs for the up and the better shorts for the way down. And last one is value funds. Value funds try to identify any kind of undervalued security for whatever reason, like investing in platinum. Now, if it's going to be a market neutral fund, it's going to invest long platinum and short gold. Whether they both go up or down doesn't matter. What matters is that platinum performs better than gold. And that completes the types of hedge funds and probably the whole lecture. All right.